Welcome to episode 16 of the Cash Flow Connections podcast. The topic for today is investing in America's most underappreciated cash cow. That's right, we're going to talk about mobile home parks, finally. We're going to discuss why this asset class makes so much sense from an economic standpoint as well as an investor's standpoint. We're going to discuss how it's possible to add $1 million in value to a mobile home park without really that much significant capital expenditure. It's totally possible. I've invested in properties in which this has taken place. We're also going to talk about the details of managing this asset class. I'm sure if some of you that aren't that familiar with the space, the management is the major hurdle. So should you be considering hiring a manager that already lives on the property, or should you be considering hiring a third-party property management company that may be more sophisticated but probably a lot more expensive? All of this and more today. Now, just a reminder, if you are an accredited investor, make sure to go to cashflowconnections.com and sign up for an account if you haven't yet done so. Like I said, there's a lot of really exciting things going on right now. A lot of people have been contacting me saying, we're late in the economic cycle. I don't see any opportunities out there. Stocks are completely overvalued. What do I do? Well, we have some of the answers at cashflowconnections.com. So if you are an accredited investor, make sure go to the website, click sign up. That way you'll be able to have access to all of our opportunities and you'll be able to be updated as we have new opportunities come to the site. Also, if you are not an accredited investor, you can still get updates when we come out with educational content such as podcasts or articles, etc. And you can be kept in the loop in terms of our perspective about what's going on right now in the market. So whether you're an accredited investor or not, make sure we have your email address. And if you are an accredited investor, make sure you have created an account so that we can send you our live investment opportunities. Let's go ahead and get straight to the interview. How's it going, everyone? Today, our guest is Ryan Smith, who is a managing principal of Elevation Capital Group. Ryan brings with him more than 15 years of business experience in market evaluation, property analysis, management systems, due diligence, and investor relations. He is the co-manager of multiple investment funds which specialize in investing in mobile home parks and self-storage assets. Ryan is also a well-known speaker at mobile home park conventions. Not only this, he has been a commentator alongside the likes of Rudy Giuliani, General Colin Powell, and several other notable individuals. So Ryan, honestly, an honor to have you on the program today. Really looking forward to this conversation for a lot of reasons.
Thanks for having me.
So we're definitely going to talk about mobile home parks today, which is probably my favorite asset class in the entire field of investing. But before we jump into those details, tell us a little bit more about your story and how you got interested in mobile home parks in the first place.
Sure, I'd be happy to. And once again, thanks for the opportunity to do this. Always like sharing the merits of an asset class that I think more people are waking up to, and for good reason. So kind of for my story, it's an interesting one. I'll make it short. I grew up in a family that was a real estate investing family. My father invested in single family residential. He is ADD, ADHD, very smart, capable guy, but needed help with analytics and kind of running his models. So at a young age, I helped him with that. I was also a coder, loved writing software, and loved finding ways to code applications for needs that I saw. So ultimately, wrote an application for his business that helped him make better financial decisions regarding his assets, and ultimately put the power in his hands so that he could do his own modeling simply and quickly and powerfully. And so built that software company up, ended up licensing my software, selling my software to over 100,000 investors, all over the place, and built a pretty successful business at it. And in short, that produced some cash flow. So I made quite a bit of money at such a young age, from that business, which was interesting. At this point, I was a teenager. I was athletic. I say was athletic because I think that's pretty accurate, given where I sit today. But I'm 6'8" at the time. And, in high school, I was, roughly 230, 240. Basketball player, baseball player, got drafted out of high school by the Baltimore Orioles to play professional baseball. Ultimately, valued my education. Went to college, played baseball in college, had a lot of fun. Got drafted again by the Anaheim Angels, and ultimately had some opportunity to play once I completed my collegiate career and got my degree. So, I had a chance to pursue the athletic path. I had an opportunity to pursue, a business path, having already established, a fairly successful business as a teenager, and ultimately I chose, to pursue the business path. Not that I had to choose one or the other, but ultimately that's what I chose, and I haven't looked back and haven't regretted it since, and certainly don't now. So, in my early 20s, to make a real long story short, my family was in real estate. My wife's family was in real estate, both very similar. Single family rental, own the house for 30 years, have the tenant pay it off, kind of, pretty standard model. So we had, capital. We had some significant capital from my software background. We had a tool that we could use, this tool that I had built. We had an awareness that real estate was a great place to play. And so we started deploying our own capital, based on our own credit in order to, build our wealth, grow wealth, create income, pretty much everything. I think, the same thing I think everybody listening to this podcast would probably say that they would like to do with their own capital base is certainly what we were looking to do with ours. And so we went out and we bought, roughly 20 properties pretty quickly in the Central Florida area, which is where we grew up. That's where we live now. So College Park, Winter Park kind of area. And we pretty quickly realized it wasn't a scalable model. The single-family residential model wasn't scalable. We were looking at our cost structures, and simply put, we thought if we've bought nearly 20 properties and our margins haven't thickened at this point, it at least poses the question, will they ever? And ultimately, we said, if we're in our early 20s, with call it 20 or so assets, if we're in our mid 50s with 500, 50, 100, whatever the number is at that time, will it ever improve? And ultimately, we determined that it was not likely that our margins would thicken. And so we ultimately determined that was not a scalable model, and we were going to seek a better path. So we hit pause. We spent about a year and researched all kinds of different asset classes. We researched apartments, office, retail, industrial, billboards, storage, mobile home parks, the gamut. And ultimately determined that mobile home parks and self-storage particularly were were what we thought the best places to deploy our capital in were. And our criteria was to simplify it. We were looking for risk-adjusted returns or asymmetric rewards, or a reward that was not commensurate with the risk that we were taking. And so, self-storage and mobile home parks stood out to us, but because we had limited amount of capital, we thought our dollar could go a little further in the mobile home park side of the business. So ultimately, we determined at that point to move forward in the mobile home park business and to build a portfolio. And the thing we liked, I think that kind of the overriding, statement, anytime today you're listening to somebody talk about mobile home parks, I think most people find themselves wondering why in the world they're even listening to a discussion on why mobile home parks are a great place to deploy capital. I mean, it's just so countercultural. It's just odd. Obviously not to me, but to the vast majority of people who would probably think that way. But in short, in a statement, the crux of the value that is evident in this space was realized to me, well over a decade ago, and it was simply put, mobile home parks are needed everywhere. That's not a subjective statement. That's pretty absolute. Mobile home parks are needed everywhere, and they're not allowed anywhere. I'm sure, your listeners, I'm sure those of you listening right now, are located all across the country, and just think to yourself, would any place 5 miles where you're sitting right now, would they want to build a new mobile home park? And of course, the need is real. The need is there, which is amazing to be able to say. But the availability, the ability to add supply in your market is likely, there's probably pretty heavy barriers to entry socially and economically against that action. So in short, we thought it was a very moated business. We thought the moat was actually the stigma around the asset class. And I jokingly, I guess, could say, if after listening to this podcast, you decide that this is the worst thing you've ever heard of and just a terrible idea, that I have to thank you for perpetuating the stigma, which continues to protect our capital. So with that, I say a big thank you from all of us to all of you. But ultimately, I think you'll see through that, because it doesn't take a stretch of the imagination. But ultimately, for the reasons I've described and far more, we started deploying capital into mobile home parks. I will say I was somewhat skeptical, given the fact that there's this generally held true notion that the greater the return, the greater the risk you're taking, and that it's fairly linear. For me, I saw the potential, at least through my modeling, that this space could produce. I was somewhat dubious of it. So we spent about 6 months trying to poke holes in our thesis, find where we might have made a mistake. And ultimately, we couldn't find one. So we had to, either move forward or stop, fish or cut bait, per se. And we actually went forward. We bought a mobile home park. It performed to our underwriting. It performed to our expectations, which was great. But to be pragmatic, 1 point does not a trend line make. So we went out. We bought another mobile home park. It performed as we expected it to. So now we have 2, which is good. We bought 3, 4, 5, 6, 7. And continue to build from there. So that's kind of the early story of how we got into the space and got going. And certainly I can continue the story to present if you'd like, but that at least creates the movement of the story.
Yeah, absolutely. And you definitely touched on some stuff that we want to get into the details of from a big picture perspective. I see this supply demand situation, which you brought up. Something that I, always like to point to investors to is that there are 10,000 baby boomers retiring every day, and very many of them have very little savings. So they're relying on Social Security. But the average Social Security check in the U.S. is less than $1,400 a month. And the average two-bedroom apartment in the U.S. is close to $1,200 a month. So there's just a perpetual amount of demand for affordable housing in the United States, but you have this really rare situation. There's all this demand and literally decreasing supply. The supply decreases every single year because of the stigma, which you're referring to. So it's from a big picture perspective, that doesn't paint the whole story, but that's definitely a good starting point from an economic standpoint in terms of the supply demand disequilibrium, which is very rare.
For sure. I agree wholeheartedly.
So let's talk a little bit about the investment strategy from a big picture. Typically in the industry, do you guys buy the homes on the parks, or do you buy the parks themselves? And kind of explain why which one is more preferable.
Sure, and I'll give you a continuum or a spectrum of our experience, because I think, depending on who you are listening to this podcast, you may have a varying degree of experience from new to expert and everywhere in between. So when we started, it was really all about income. It was all about generating income. So I was young, in my early 20s. Our goal was to generate $10,000 a month of net cash from our business, and that was so our strategy was produce income. It has, I would say, and this is to a degree self-aggrandizing, but I would say we've matured our focus over the years to focus less on purely cash flow and income and more on wealth creation and value and capital appreciation of the assets. It's we believe it's more significant of an outcome. It's more tax efficient. There's a lot of leverage a lot of things you can do to lever that. But the point in saying all of that is, early, given that view of cash flow being our goal, you look at it, purely, kind of simplistically, and you say, okay, well, I can rent the lot and I can rent the home, therefore more cash flow by owning the homes. We have definitely steered our business away from that over the years, and you can see this in a number of ways. So presently, our goal is to own no homes. Our goal is to own just the land and have none of the homes. There's a lot of reasons for this, but in short, if you bifurcate the business into the lot business or the lot income business, and then the business of owning and renting homes, if you properly allocate what we would define as properly allocate all your expenses due to owning the homes, we have found, generally speaking, the expense to income ratio from the home component of the business typically exceeds 100% of the income. So your cost associated with managing those assets actually is greater than the income it produces. So when you blend it back together on a net basis, it actually is a headwind to the overall profitability of the park. And the problem with that is if the value of the park is a multiple of the income from the land, okay, the land is then offsetting and subsidizing the deficit of the home business. So you're actually eating into your profitability, and you're actually costing yourself value on the back end. So and really the key to that, and I've seen this a lot of times. Had a conversation last week with a young guy, very driven, very entrepreneurial. I think he'll do quite well, but he probably will have to revise his model. But his model is, you buy a home for whatever it is, $15,000, $20,000. You rent it out and you make $300 to $400 a month of cash flow. My question to him is, will that home one day be worthless? And he said, yes, it's a depreciating asset. It'll be one day worthless. I said, so how much are you setting aside in your monthly cash flow for replacement? And there was a long pause, which also was the answer, which is nothing.
Right.
And I don't say that in a critical form. It just I would further qualify what he's calling cash flow. Because it's definitely So anyway, I think I've explained it sufficiently at this point. But in short, we do not want to own the homes.
Yeah, that makes total sense. And I think that there are also some, there's differences in the tenant base when it comes to who is owning your home and who is renting a home, or potentially in the process of, in that stage of their life. A lot of the reason for this is that the pride of ownership is much higher in a property where the tenants actually own the home. I mean, in multifamily, one of the goals is to make the tenants treat the apartments as if they own it. Well, in this space, if you're buying the right parks with the right profile, the tenant should treat the homes like they're theirs, because they are, which really decreases your expense ratio, because of the fact that the pride of ownership is so high. So having said that, though, given the fact that this space caters to relatively low incomes, this isn't always the case. So is park-owned homes, these are homes that are not owned by the tenants but are technically owned by the parks, are there certain limitations that are you not willing to buy a park that has any park-owned homes, or is it 50-50, or where is in the range that you feel comfortable, looking at a park for potential purchase?
Yeah, good question. In to touch on one thing you said, and then to answer the question you just asked, as it pertains to expense ratios, and you're exactly right. The more the greater percentage of homes that the park owns, the higher the expense ratio. Generally, you'll see, call it 50%. If a park owns quite a bit of homes, the expense ratio would likely be plus or minus of 50%, or half of the income being consumed as expenses, mostly allocated to maintaining and fixing the homes. If you own none of the homes, generally speaking, it could be in the 30% range. In some cases, it can be in the 20s. In some cases, the low to mid 30s. But as a spectrum, call it 30 to 50% of expense to income ratios. So obviously, if you're at the 50% expense to income ratio, you'd love for it to be 30. And the way to get there is to sell off the homes, create pride of ownership, create a community. You have stickier tenants. It's more attractive, all of those things. You can possibly charge more lot rent, which contributes to NOI. You're starting to create a positive cycle, for profitability. But that's all, what you just described very well. In terms of your question regarding, kind of underwriting an asset and what allocation to homes, of park-owned homes, would we want, it really depends. It's a hard question to answer. It's a great question, but it's really hard to answer because every property is its own puzzle. Everyone is very unique. There are different sets of considerations. So I would say there's also the kind of the life cycle of your business and what you hope to achieve. If your goal is to, buy one asset and, manage it successfully for 20, 30 years and that be your retirement, then maybe you're willing to take on more of a project, which, obviously more homes in the park I would equate to more of a project, more of a turnaround park. It'll take a little bit more effort over time, but it'll produce, it's likely to produce some pretty significant rewards over a long period of time. But for our purposes, it's not as scalable. So we get bogged down in the kind of the labor requirements that it takes sometimes to turn around some of those heavier acquisitions from a turnaround standpoint. So we're more nuanced in what we're looking for, but I don't want to poison the well and say, if there's 50% of the park is homes that are owned by the park, then don't buy it because, it depends on what your personal goal is, what you're hoping to achieve. For some of you on the call, that may be perfect, right up your alley and pay, huge rewards over time. But generally speaking, if you're looking to build a portfolio over time, I'll say as a general statement, you want the portfolio probably to be sub 30% at acquisition.
Got it. Yeah, that's definitely a good answer. I appreciate the adding the extra color there from your perspective. What geographic locations are you finding makes most sense for this asset class?
Yeah, good question. And once again, I'll kind of give you the way I think about it in part and parcel, and then that way each listener can, kind of know what part to substitute their preference for, and maybe that'll change the area. So if you think of it conceptually as, if you remember back to grade school, the old overhead projectors and the transparencies, basically there are different risks that we consider, and think of each risk as a transparency on the overhead. So as you stack them one on top of the other, geographically it starts isolating where you play ball, for lack of a better term. So there are a number of risks. One would be, in no particular order, regulatory risk. Risks like the Tenant Landlord Act by state. There are many, every state has their own Tenant Landlord Act, and it really defines whether or not for that state the laws are slanted more towards the tenant, or more towards the landlord. Obviously, I don't even need to state what our preference would be. It's probably your preference too, but the point is we want a favorable Tenant-Landlord Act. California is problematic, Oregon's problematic, Washington's problematic, North Carolina, and typically, and this is not a political statement. The last thing we're going to do is get political, but I think as something that's a general rule, if the state is generally liberal, then it's typically slanted towards the tenant. If it's more conservative, then it's typically slanted towards the landlord. There are exceptions, but as a general rule. So obviously, if you want a favorable environment legally, to buy in from a landlord perspective, then the Midwest is accommodating or generally accommodating. There's a lot of other regulatory items that I can reference, but just to pick one other one, rent controls. We do not want to buy in rent-controlled markets. As an aside, it's somewhat ironic that typically it's pretty often that you'll find rent controls actually create the problem they're meant to help solve. And there's a whole discussion there, but it's somewhat ironic. But we avoid rent controls, for the probably the obvious. We don't want to be told what we can charge. We want to charge a market rate, and we want the market to freely speak into that. If you're listening to this right now and you're in California, I've noticed a lot of times people who live in a certain area think the rest of the country is the same way. So I've talked to a lot of people who say, well, aren't rent controls everywhere? No, they're not. It's actually very rare, mostly isolated, New York and California and some other specific areas. So those are two things we'd like to avoid. The Midwest is accommodative. Some other, just broad considerations. We want to buy in an area where there's been a lot of, really steady long-term population growth. Think Buffett. We try to avoid boom-bust markets that have, huge inflows and huge outflows, and it's rise and fall, boom and bust. We want something that's steady Eddie, has been consistent for 10 years. Just kind of boring long-term growth. That's something that we think is more stable and predictable, and predictable is good. So we want job growth in the region. Midwest has had a lot of job growth, a lot of companies fleeing California and more regulatory, challenging environments. So the Midwest has been generally growing, depending on what area, but on the whole, it's been growing. There's a diversity of employers and a diversity of industries. So if any one employer were to collapse, if as long as the city has a bevy of them, it's survivable. And we also don't want to buy in a city with one industry or one employer. We try to avoid that correlation risk that could occur there. We're looking for stratification. So we want the markets we're buying in, we want there to be clear stratification. So if you look at the map of where we own geographically, in the United States, we own in about 30 states. You'll see the Southeast is we do not own in the Southeast. And sometimes people ask, is that intentional? Of course it is. The problem with the Southeast, and bear in mind, I don't know why I feel the need to say this, most of my family's from the Southeast, so don't, this is not a personal remark, but just as pragmatic as I can make it. When you look in Mississippi and Alabama and Louisiana and in certain parts, I can go on, but you'll see a house that is, for sale for $40,000. So the monthly payment on that, to the extent that they finance, would be, call it $300 plus or minus. Call it $400. The apartments rent for $300. Mobile home lot rents are $150 to $200. But the problem is they're pretty much capped out. There's not a lot of room that they can go up, because at that point people are saying, why am I living in a mobile home when I can buy a stick-built house? So you want stratification. You want very clear separation between comparable products or products that could be deemed comparable at the right price. So as a contrasting example, Austin, Texas, and this is generally speaking, but a person buying a 3-bedroom, 2-bath house in Austin can expect to pay roughly $2,100 a month, out the door. And apartments in Austin are roughly $1,600 a month, and our average lot rent right now in Austin is roughly $400 a month. So as you can see, very clear stratification. And what happens if there's a downturn? If there's a downturn, single-family house prices may fall as a result of that. Apartment prices may fall, similar to 2008, but we do not have to adjust our price. We can actually, we have the chance to continue to increase our rents because we're so far away from the other products that could be deemed comparable at the right price, because there's clear separation. So that's something that's important to us. Acts of God risk, insulation from acts of God risk. Obviously there's a lot of things we can talk about, but just to make it really simple, when people look at our portfolio, they typically, we try to avoid hurricanes. To the extent that we can, we don't want to get hit by a hurricane for very specific reasons. But they'll look at our portfolio and they'll say, well, you seem to buy a lot in Tornado Alley or where tornadoes go. So long story short on this, I'll make a real quick comment on this, but maybe helpful. So the way we think about it is there's 2 buckets of risk. There's an asset level risk and there's a market level risk. And in short, we can insure the asset. We can get insurance to protect us on the asset level risk, but it's very difficult to insure the market risk component. So hurricanes, if a hurricane hits New Orleans, and I have a mobile home park, let's say in New Orleans, which I don't, but just hypothetical, let's say we do, can I insure the asset? Yes. So after, let's say the city is hit, let's say the asset is restored to its former glory, our tenants are we have historically not done Section 8 rent. So our tenants are, they're people who make $20,000 to $30,000 a year. They're your, manager at Walmart, or they work in the service sector, but they are employed. They're deriving a wage by which to pay their rent. So if my asset is restored, but the market that the asset is in disarray and is in shambles, like New Orleans or Homestead after Andrew, there's a lot of examples, then my tenants cannot go out, get a wage, and therefore they can't pay the rent. And if they can't pay the rent, it's not generating income, and you see where this goes. So the market risk component is actually the challenge for me with a hurricane. On a tornado, when you look at a tornado, a tornado does hit a market. But historically, if you think back, what is the last tornado that hit a city and completely devastated it to the extent that it's still not the same? And you'll really struggle to think of it. The last major tornado that I can think of is Joplin, the one that hit Joplin several years back. In Joplin, within arguably 6 to 12 months, was back to being Joplin. Because in short, the path of a tornado is much more narrow, much more specific, and there's enough capital, there's enough federal money to restore a specific area, but there's not enough money to restore a city the size of New Orleans. So in short, tornadoes are not as problematic in our view as hurricanes. You may take a different view, but that's ours, and for those reasons. So when you take a look at all that I kind of just went through and think of them as slides on an overhead projector, where is there less acts of God risk? We think the Midwest. Where's there growing population of people? Midwest. Diversity of employers? Midwest. stratification and low cultural risk, Midwest. Good regulatory environment, Midwest. Culturally acceptable, Midwest. You kind of get the theme. So that's generally speaking where we buy.
Totally, it makes sense. I mean, you touched on a ton of things there, all of which are really important points. I'm really glad that we're having this conversation right now. I'm definitely learning a lot already, so I'm definitely looking forward to it. One of the things I want to touch on just briefly is the stratification is probably the most telling of that entire portion on geographic locations. I mean, if you're looking at a market, you mentioned Austin, where lot rent is, I think you said $400 a month, and a two-bedroom apartment or a standard two-bedroom apartment would be about $1,600 a month. That is crazy. I mean, you could see how aggressive you can be with rental income for years, potentially even decades before you start to get pushback. I mean, if you're in a situation where you're going from either $400 a month to $800 a month, that $400 a month to people that are in low incomes is really a significant amount of money. That extra $400 a month is significant. And when I say low incomes, this is a much bigger portion of the population than people think. 51% of the wage earners in the U.S. are making less than $30,000 a year. 51%. There are currently I think it's about 20 million people are living in mobile home parks. So this is not a small market at all. Kind of to change topics there real quick, in terms of tenant diversification, in terms of the size of these parks, what are the purchase prices you're looking in, and what are the size? How many lots are you looking at?
Yeah, great question. So once again, I'll kind of cater the I'll cater the answer to a variety of potential listeners, depending on where you are on kind of the continuum of experience, because it may be one or the other. So to me, where we started, we generally wanted 30 units or more. We wanted to stay away from the 10-unit parks, the 15, the 20-unit parks, because even at that size, you have to ask yourself, is it actually a park? One of our due diligence items is to actually confirm it's a mobile home park. It's permitted as such, and it's not just 10 mobile homes on a piece of land. I talked to a gentleman about, it's been probably 6, 7, 8 months ago, who was telling me about the park he owned, and what he ended up finding out on the call in just a casual passing conversation is he didn't own actually a mobile home park. He just owned mobile homes on a piece of land. And that's actually incredibly problematic. I can't understate that enough. So the point is, once you get below a certain size, number one, there's some other problems that could open up. The one I mentioned. The other is there's not as your potential buyers in the future are likely much smaller mom and pop. So the multiple that you can get, the cap rate that you can get, will likely be much higher on the sell side. And a lot of times people look at them and they say, well, I'll try to use more common cap rates today, but I've heard people say, well, I can buy a 12 cap or a 11 cap or 10 cap or 13 cap. While that may sound wonderful, you have to ask yourself why. Why would somebody sell a 12 cap if the market rate is much less? And what I think is a broad statement and is at least reasonable to think is there might be a chance that you might have to sell at a very high cap to get a buyer in the future as well. So you got to think problems on entering into an acquisition could be problems exiting an acquisition. You have to think kind of on both sides of the coin. But that being aside, I would say generally speaking, I wouldn't go less than 30 units. That doesn't mean if you see a sweetheart deal at 29 to pass on it. Trisha Yearwood said years ago, everything in moderation, including moderation. So which I like that statement. So the point is, generally 30 units or more. If you're just starting out, probably 30 to 50 as a range. Today, our average is around 125 units per park. A large park for us is 500 units. We own a couple through our vehicles that are in the 500 unit range, 400 unit, but generally speaking, about 125 to 150 is an average. In terms of purchase price, call it the last 24 months, our average has been between 2 and 4 million generally. We've had some much larger and some much smaller, but we generally don't go under $1 million on the purchase price because then it becomes more challenging to finance. You actually have far more options above $1 million than you do below. and you have far more options above 5 and above 10, and that continues.
That makes sense. And what cap rates are you seeing in those ranges?
So on a trailing 12-month basis, our target has been to buy at around eight cap, from manufactured housing, 8 cap. The market, I think it's arguable, but we have reasons to believe it's a little bit lower than that. But that's what we've seen in the last 12 months.
Who would you anticipate your major competitors being? Is this typically single-family houses or B or C class apartments? Who are you kind of looking out for when you look at a market?
So that it kind of goes. It's kind of a circular question. It's a great question, but the answer is somewhat circular based on what we've talked about. In that, it depends if you've evaluated the market correctly. If everywhere you look there are competitors and class A, B, and or C apartments and single-family houses, then you likely do not have sufficient strata, which would cause me pause, for that market. So, for example, in Austin, Texas. And there's many other markets, but this is a good example. There's really not a lot of competition, other than just other mobile home parks. But then again, there's so much demand. It's like fishing in a stocked pond, and worrying about how many fish you're going to catch. Maybe that's a terrible example, but the point is there's so much demand, supply is so constrained. It kind of removes competition because everybody's going to leave with a fish.
Right. That's a good point. So this is definitely something that we definitely want to talk about, just given the perception of the asset class. So really the X factor in this asset class is management. Let's talk a little bit how you manage these properties. How do you select a property manager? Is it a third party? Is it someone that already lives on the property? What's your strategy there?
Yeah. So historically, we're actually transitioning. So, I'll say maybe in a year or so, you come back and revisit on, kind of the outcome of this transition. But historically, we've approached it from the standpoint of having the manager live on site, giving, a discount or free lot rent, and it's a part-time job. But in general, the manager lives in the park and on site. Given our size in total that we've grown to, we're transitioning to something that's more institutionally accepted in terms of management strategy, and there's strong merit for it, and that's evidenced in our desire to even entertain it first and decide to start transitioning into this. And the transition is to build concentration of ownership in a specific market, and rather than having on-site managers at every park, hire a full-time manager and pay a pretty sizable wage, a meaningful wage to a person who's just flat good at what they do, and it's a full-time gig, and they run several properties in that market, and that seems to have some merit too, but is only really attainable if you have scale in a market. But that being said, historically we've had managers on site, and that has worked fairly well for us. So it's not given the fact that I mentioned we're transitioning from it, it doesn't mean that there's no value in it. It's just given kind of the size and shape of our business and where we're going, that transition makes more sense.
Okay, yeah, that makes total sense. When you're looking at a property, what are some of the key ways to add value to these mobile home parks?
Yeah, so for us, we focus on reducing capex or capital related expenditures as much as we can. We're generally not going in and buying properties where we have to put in $50, $100, $200,000 of capital to physically improve the infrastructure. So we're not paving roads, we're not fixing sewer issues or plumbing issues, or converting typically from private utilities to public utilities. Obviously, we like to buy public utilities. But with all of that, the three things we really focus on when we buy an asset, and they're all operational in nature, is one, we want to the extent that it can be purchased, the asset, let's say, is currently charging a rental rate that is below market. So if market, let's say in Austin is, or let's just say in any market, doesn't matter. Let's say if in any market's $400 and the current owner's charging $300, then that's something we see value in because we can push rents over time on that asset. And we may push rents over 2 or 3 years. We're not in the business of being off-putting and causing people financial harm for its own sake. But at the same time, we need to move the rate to market over time. We tell them what we're going to do and how long it'll take, and so there's no guesswork there. So we want to push rents to market, and then keep up with market as market changes over time. We want to fill vacancies. Oftentimes in the space, it's vacancies related to a pad that's fully improved, but there's no home on it. So we have partnerships with Clayton and a number of the manufacturers where we'll bring in homes and fill those vacancies through our size and our relationships at pretty favorable terms, or more favorable than paying cash for the homes and bringing them in. So that's another one. And then lastly, expense related, bottom line focus. We like to cut expenses. I can give you just a ton of examples. We had a park we bought years ago where the owner was paying the manager, off of memory, it was something like $100,000 a year to manage the park. And I could describe the reason. He was, I'll be very broad, but he was much older than her, and she was much better looking than him. And that's as far as I'll go with the story. You can fill in the gaps, but the point is, she was being paid an unfair wage by market standards. So there was an opportunity to cut expenses. So we did not hire her as manager. And by the way, he hired her for another one of his properties. So everybody was happy. But ultimately, we like to cut expenses. So sometimes managers are overpaid. Sometimes they're just underperforming. But the big one is usually related to utilities. We like to buy parks where, the park is currently paying the utilities for the residents. And when I say utilities, it's not typically power. It's typically water, sewer, trash. But that's a pretty big expense. It could be, depending on the size of the park, it could be $5,000 a year all the way up to, in excess of $40,000 a year. So if you have a $40,000 expense item that you can pass back to the customer, and your park is, let's say, you cap it out at say 12 times earning is the value of a park, let's say, just using that as an example. That's you cut utility expense of $40,000 a year, you just created roughly $480,000 in value, or potential equity, which is pretty good. So the three things we're looking to do is cut expenses, we're looking to push occupancy and push rents. And by the way, I just want to make this really clear, because to me, I cannot underscore, this connects to something I said earlier about how our business matured over the years and how we're focused, much more on capital appreciation and value creation, i.e. wealth creation. And it kind of, as an example, it's very much Jeff Bezos and the standpoint of Amazon. A couple years ago, he removed all the light bulbs from vending machines in the warehouses of Amazon. This guy's, you'd say, well, he's neurotic. And no, he just looked at the fact that, there's a cost to the bulb, there's a cost to replacing the bulb, there's a cost to the power that's, flowing through the bulb. And if I cut that expense at, Amazon's given PE rate, it's a significant wealth creation by the savings of $1. And simply put, in mobile home park, if you can save $1 a month, that's $12 a year. Times let's just take it at 10 cap, which is very low valuation. That's 120. So $1 a month is $120 in equity. That's significant. So go find as many dollars as you can, and you can say, okay, well, I can save $1 to get 120, or I can create $1 to get 120, $20 in equity. We do both, but the quickest path to that 120 is saving $1. So we do both, bottom and top line.
Yeah, basically the things that you just outlined are really what makes this asset class so compelling. When you compound what you just outlined with the demographic issues that I was talking about at the beginning, you have a very clear picture as to why this asset class is so favorable from an investor standpoint. The first thing you just mentioned there was finding a potential park that should be renting for $100 a lot more than it's currently renting for.
Good.
Right. That is just completely unheard of from a percentage basis in other asset classes. because there is so much significant mismanagement out there, and you have this significant mismanagement, you have monthly leases which allow you to raise rents more effectively, more quickly, and then you also have an incredibly sticky tenant base with not a lot of other options. If you have $100 a month discrepancy and you have 125 lots on average, I mean, times 12 divided by an 8 cap or so, you're talking about $1.8 million just because of rental increases, not to mention the other operational costs or expenses that you were talking about. I mean, it's perplexing, and it's very unique to the asset class. Definitely paints a clear picture as to why it's so interesting. You mentioned the Clayton program. I do want to touch on that briefly just because it's interesting. There's a program out there called the Cash Program. Do you utilize this program, and is this something that you're kind of using to bring in homes?
Yeah, we use a number of programs. So we have programs set up with a number of the manufacturers. And in short, I guess the broader context to the question, and I guess for the understanding of your listeners, is historically, there have been there are broker networks, or I should say dealer networks, that the manufacturers would use to sell their product to the end consumer. Those were pretty significantly harmed in the downturn of 2008, primarily because demand went through the roof for mobile homes. The problem was there was a freezing of the debt markets and the credit markets overall, and so there was really not much financing. If you can imagine back in those days how hard it was to buy a house and obtain a loan, imagine how hard it was to buy a mobile home. And so what these dealers ended up finding is they had tremendous demand, but they really lacked the liquidity to kind of connect the dots. So as a result of that, the manufacturers saw a pretty significant hit to the number of homes that they manufactured and sold. And so kind of coming out of that crisis, they realized that they could either rebuild their dealer networks, many of whom went out of business, or were not thriving. And they realized that they could do that, and they did. But they also realized a better, or at least meaningful distribution channel would be park owners who have fully improved vacant pads that need a home with sufficient demand to fill the home quickly. That we basically would be a pretty significant distribution channel for them. And so, it's a nice turn of events because, it's direct, it's disintermediating, it's fairly efficient cost structure. And at the end of the day, it's a quality product for the end customer at, a meaningful price, a lower price than going through, kind of the local dealers in many cases. So in short, kind of the nuts and bolts, as we call, Clayton or a lot of the programs are substantively, they're slightly different, but they're generally the same. We place an order, we say, hey, we want 10 homes. Clayton manufactures them, ships them, installs them under the Cash Program. We introduce a tenant to Clayton, and it's through 21st Mortgage, which is their lending arm. So they underwrite the prospective tenant. They say, okay, this is somebody that qualifies. They provide a loan to them to then buy the home. Clayton gets the sale. 21st Mortgage gets an origination. And then what we do as a requirement of the program, we now have lot rent coming in, which is great. We contribute typically 50% of the lot rent we're now getting from that tenant towards the accelerated pay down of their home, which is a huge win for the customer, because not only are they getting a brand new home, they didn't have to, it's all set up, it's day one, it's simple, there's a relationship there, it's fairly low risk to the lender, which is helpful to the borrower. And then at the end of the day, we're contributing to accelerate the principal reduction of their loan. So, and ultimately they can be a homeowner much quicker, which is 21st Mortgage's goal. It's our goal. It's everybody's goal, and there's alignment because once they're a homeowner, once they own the home outright, 21st Mortgage is happy, Clayton's happy, and now we're not splitting 50-50 the lot rent. We're happy, because generally speaking, if the lot rent's, let's say, $300 a month, and a third is the expense ratio, you have $200 a month of net operating income from the dirt. It's $2,400 a year at a 10 cap, which is low, low valuation. At a 10 cap, that's $24,000 in value creation, without the upfront absolute capital outlay of $30,000 for the mobile home.
Right. Yeah. Thanks for the explanation there. So you definitely touched on one thing I want to talk about. the demand for the product in this asset class is incredibly stable. This has been proven decade after decade, even though the asset class, hasn't really been around as much as something like single-family houses, obviously, but the demand for the product is stable. The challenge, or a potential challenge with the asset class, is because it's a niche asset class, lending institutions can be weary of it, especially in the event of any kind of capital correction. So how do you mitigate the risk of credit or refinances, et cetera, coming due at an inopportune time or something like this? Obviously, the debt service coverage ratio is very favorable because of the low expense ratios, but how do you account for the risk of, ability to refinance, for example?
Yeah, it's a good question, and it's not. I guess my answer is, I would say it's not absolute, and I will give you my view on it. But in short, depending on what future event may arise and what the time and the severity is, there are things you can do to be helpful, but ultimately there's always something that can happen at the wrong time, and it ultimately takes your response to that event, to produce hopefully a favorable result. So that kind of is the captain of the ship question, and we think we're fairly good captains of our ship, and we can navigate various waters. But ultimately, to your question, to speak to it, there's a couple of things. So when you look back, let's say the last 10 years, there was a pretty abnormal event that occurred in 2008. Historically, it has not occurred over and over and over again. So 2008 was relatively abnormal. In one of the ramifications to 2008 is the credit markets, for the most part, froze. And there was for a lot of people in a number of asset classes who tried to refinance in that period of time, they found accessing the capital markets very challenging. They were not, in short, their loans have become due. They had a 5, 7, 9, 10-year balloon, 3-year balloon. The loan was ballooning in 2008, 9, 10. They were going to the bank saying, "Hey, refinance me," and they may have had trouble. And in many cases, the trouble really resided with the role of the special servicer. And I won't go too much into this, but in short, I want to say around 2013, I think Congress revised the role of the special servicer to give them more flexibility. At least that's the impression we have by the advice we've been given. But ultimately, when you're buying assets, to the extent that you can, you would like to stagger the balloon date so they're not all coming due at the same time, which also does create some risk too, in that it increases the chance that you'll have a loan come due, when there's a downturn, but at least you do not have all loans coming due when there's a downturn. So there's a pro and a con to that, but ultimately we're pretty optimistic moving forward that a lot of the systemic risk that occurred in the last decade has been, somewhat mitigated through kind of affirmative or kind of positive action to prevent those ramifications from happening again. That doesn't mean that there's not going to be another downturn or correction, but we hope there will not be a complete seizing of the markets for an extended period of time, because that really doesn't help anybody. It actually hurt a lot of people the last go round.
Absolutely. Kind of on the other side of things, since, obviously I'm in a very weird niche. I think the listeners to this program are in a even not as extreme niche as me, but they're definitely aware of these type of alternative investments. I have noticed a significant uptick in the interest to the asset class of mobile home parks. This is something that's relatively recent in terms of the attendance of mobile home park conventions and just the overall number of deals I've seen with mobile home parks as a component. Do you find that this means that there's time running out in the asset class, or has this competition affected the business model at all?
Good question. It's actually a really it's a difficult question to answer, which is, by the way, the sign of a good question. So my compliments. The reason why it's difficult is it depends on your view, your perspective, and really your strategy. And I'll define kind of what I mean by that reply. To me, historically there have been a lot of people who've done quite well in the space. And it's my opinion, but without excellence. They were in the right space at the right time. They weren't truly excellent at what they did. They just benefited to a degree of market timing. So they did an okay job, but let's just say not an excellent job, or not as good as otherwise would have been required in another asset class. So I think to use a term, I think the days of the easy money are in their latter days, if they still remain at all. We do think, it's my opinion, that the market will continue to consolidate. I think we've reached the tipping point. Certainly the last, really since 2014, 13, 14, people started, there was a search for yield. There was a growing, feeling that there could be a correction around the corner. And to be fair on that, I've had people tell me that the correction was coming, any day now for the last 3 or 4 years. And eventually they'll be right if they keep up at it. But right. The point being is, to be fair, but really there has been a significant uptick. There is a noted and notable growing interest in the institutional community. I can rattle off a number of private equity firms that we've spoken to in the last 12 to 24 months, and many of them are household names. I mean, big firms that really have a strong interest in this space. So that being said, does that day one mean it's over? No. We continue to buy. We continue to be very optimistic. But ultimately, we do think cap rates will over time compress. We think valuations will continue to increase. And I'll make one comment on that. Like anything in a market, markets go up and down. So that doesn't mean I'm predicting a straight rise in value. I think my view is, generally speaking, cap rates will look like a young boy playing with a yo-yo on a downward moving escalator. It'll rise and fall over time, but I think generally down would be my feeling today. So but that being said, at the end of the day, the question is, I think same question for you as it is for us. Do we still see opportunity in the space? Do we think we can create value? Do we like the kind of the macro micro factors surrounding the space? And ultimately, the answer is yes, because for us, the way we want to operate our organization is we want to be excellent at any and all parts, and we want to thrive due to pragmatic execution of a good strategy with excellence over time. And by the way, all of those components are necessary, we think, to a successful end. Because ultimately, if and when this industry consolidates, that is not the end of the opportunity. That's just that you can qualify that maybe as the end of the easy money, period. But I'm not opposed to working, I'd say harder for a good outcome either. So to me, I think there's a lot of life left in the industry in the coming decades. It would be my best guess.
Awesome. I think that really summarizes it really well. And Ryan, again, I really appreciate you coming on. A tremendous amount of educational content. I'm sure the listeners are really going to appreciate that. If you want to just let them know the best way to get in contact with you so that they can contact you directly, just go ahead and let them know your contact information.
Sure. So my email address is ryan@elevationcapitalgroup.com. Our website is the same. It's elevationcapitalgroup.com. My phone number will be on there as well. My direct line is 407-602-7662.
Awesome. Ryan, thanks again. Really appreciate it.
Yeah, take care. Thanks a lot.
Well, guys, there you have it. Those are several of the reasons that I really love the mobile home park asset class. I think that it's pretty much unparalleled to anything else that's available out there. I will say that self-storage has a tremendous amount of value add potential because of the complexities of the asset class, but both mobile home parks and self-storage are just tremendous. I mean, those two asset classes make up a significant portion of my own personal portfolio as well as my business overall and what we're trying to accomplish. So if you're interested in investing in either mobile home parks or self-storage, don't hesitate to reach out to me or create an account on Cashflow Connections. These are the type of asset classes we think are prime, both from an economic standpoint and from an investor standpoint, and we'd love to help you get exposure to these asset classes. So you can send me an email, hunterthompson@cashflowconnections.com. Be happy to help you out. Thanks a lot.